Good morning, Ma'am Gagape. I am Christian Rizal from Group 2 and we will be presenting the asset management of Jollibee Food Corporation Company. And I will be taking the company background. Jollibee Food Corporation is engaged in developing, operating, and franchising of quick service restaurant under the trade names of Jollibee, Chowking, Greenwich, Red Ribbon, Mang Inasal, Burger King, Donuts, Po24, Hard Rock Cafe, Highlands, Smash Burger, Yohe King, and Hong Zong Yum. The Jollibee Food Corporation is the largest fast food company in the Philippines. The company operates through the following segments: food service, franchising, and leasing. The food service segments operates quick service restaurant and the manufacture of food products to be sold to Jollibee Group owned and franchise quick service company. The franchising segment franchises Jollibee Group quick service restaurant store concept. And the leasing segment leases store sites mainly to the Jollibee Group independent franchises. Jollibee Food was founded by Tony Tan Kak Chong in 1975 and is headquartered in Pasig City, Philippines. Next is the Jollibee Food Corporation assets. In the year 2019, the Jollibee Food Corporation has a total assets of 198.27 billion. The year 2018 total assets of 160.46 billion. This would give a 23.56% asset total growth of the as I observed in the Jollibee Food Corporation asset, the intangible asset has a big impact of the increase in total assets from 31.62 billion in year 2018 to 50.29 billion in 2019.
Hi ma'am, I am Sharmil Pepito from BS Finance 3D, and in addition to what Mr. Rizal said, asset management ratios serve as tools to analyze how the business is managing and utilizing its assets effectively and efficiently to generate sales or revenues. So JFC, or the Jollibee Foods Corporation, as we all know, is involved with the food and beverages industry, which makes them a part of the consumer goods sector market, wherein they make and sell products that are intended for direct consumption or use by the consumers. The company generated its resources at an advantage, which are translated into earnings. So Jollibee Foods Corporation has to determine the right amount to invest in each of their asset accounts. They have to keep track of how much they have invested in their asset accounts year to year and see what works and what happens. So the asset management ratios are computed for different assets. This includes inventory turnover, days sales in inventory, fixed asset turnover, total assets turnover, average collection period or the days sales in receivables, receiving turnover, and the net working capital turnover. High asset turnover ratios mean that a company is utilizing its assets efficiently to generate sales. This means that the higher the asset turnover ratios, the more sales the company is making. On the other hand, the low asset turnover ratios mean that the company is inefficient on the utilization of assets. This means that the company is not managing its assets wisely. Let us know if Jollibee Foods Corporation is utilizing and managing its assets efficiently and effectively from 2015 to 2018.
Hi, I am Clint R.D. David and I am going to explain to you the inventory turnover ratio of Jollibee Foods Corporation. Now, inventory turnover ratio is how many times does the company was able to clear and restock its inventories in a year. In order to get the inventory turnover ratio of a company, you need to get the cost of goods sold and divide it to its inventories. Now I will show you the computed inventory turnover ratio of Jollibee Foods Corporation. Here is the ratios of Jollibee Foods Corporation inventory turnover. In 2016, it has 15.80 times, 2017 16 times, and 2018 15 times. You can see in the graph that the ratios are somewhat closer to each other during the years with minimal changes. But you may notice that the 2018 cost of goods sold is has substantial increase in value compared to its 2017 and 2016. Now, I look at the Notes to financial statement of Jollibee Foods Corporation, and there are 5 factors that lead to substantial increase of cost of goods sold of Jollibee in 2018. Now, this is the breakdown of cost of goods sold of Jollibee Foods Corporation that can be found in the notes to financial statement of the company. Now, there are 5 factors that contributed to the increase of cost of goods sold in 2018, and that is cost of inventories, personnel costs, rent, professional fees, and representation and entertainment. You will notice that all of this from the 2018 has increased, but these 5 factors has increased significantly that you will notice, especially these two, that it contributed a lot to the increase of cost of goods sold of Jollibee Foods Corporation in 2018. Now, the most probable reason why the increase of cost of goods sold in 2018 is because of inflation and also increase in tax, or also called the train law. The tax reform has been and is being adjusted every year, and that may be the reason why the 2018 cost of goods sold increased substantially. Now, Jollibee Foods Corporation inventory turnover ratio is still in their company standards with minimal changes during the years. This is because of the economic risk and the risk factor that is involved in a company. Now, Jollibee Foods Corporation is still able to sustain its company's performance and still continue to provide delicious food to the Filipino people.
Now we are going to discuss Jollibee Food Corporation's Day Sales in Inventory. The Day Sales in Inventory determines how many days it takes for a business to turn its inventory into sales. A low Day Sales in Inventory means that the business is fast in turning its inventory into sales, while a high DSI means that it takes time for the business to clear out its inventory, but it doesn't always mean that it's a negative thing. Some businesses store their product for a long time, but eventually will have a high return when sold in the future. To identify Jollibee Food Corporation's DSI, we use the formula given. DSI is equal to 365 days divided by the company's inventory turnover ratio. We have here the given table of the 3-year period of Jollibee Food Corporation. So in year 2016, we have used 365 divided by its 2016 inventory turnover ratio, which is 15.8029, to come up with the answer of 23 days. We did it similarly with 2017, which also come up with an answer of 23 days, and in 2018 it's only 22 days. So it means that in 2016 it takes 23 days for Jollibee to clear out its inventory. The same also in 2017, while in 2018 it's only 22 days. So it means that they are more efficient in clearing out their inventory because they were able to lessen the days for their day sales in inventory.
So for the fixed asset turnover ratio, it is in general used by the analyst to measure operating performance. This efficiency ratio compares net sales in the income statement to fixed assets or in the balance sheets, and measures a company's ability to generate net sales from its fixed asset investments, namely the PPE or the property, plant, and equipment. So the fixed asset balance is used as a net of accumulated depreciation. A higher fixed asset turnover ratio indicates that a company has effectively used investment and fixed assets to generate sales. To solve for the fixed asset turnover ratio, we have this formula. Fixed asset turnover ratio is equals to net sales or revenue over the net PPE of the company. So the table shows that the fixed asset turnover ratio of the GFC on how the company has effectively used investment in fixed assets to generate sales. So in the table, by the year of 2015 down to 2018, it has a higher fixed asset turnover ratio compared to the recent one, which is the 2019. The FAT of the GFC from 2015 to 2018 drops by 2019 from 6.04 to 2.75. It indicates that the GFC used investment in fixed asset effectively by the year where the fixed asset turnover ratio is higher rather than 2019, which is it drops by 2.75, since they invested more on their PPE and gives them a not so much higher sales or revenue, making a cause that the net PPE is more higher by 2019, which is 60,624 compared to the 26,694 by the 2018, and by that it gives a gap for the result of the fixed asset turnover ratio of the GFC, since they invested by 2019 more on their PPE rather in 2018 that it is lower, which is it gives a gap from 26 to 60,624, but it is in million.
My name is Ayasage Razonable and my assigned task is the total assets turnover ratio. So the total assets turnover ratio measures the turnover of all firms' assets, and it is calculated by dividing net sales by total assets. So in getting the average total assets, we add the total assets of the current year plus the total assets of the previous year. So let's say we have 2017 and 2016. We add the total assets of 2017 plus the total assets of 2016, and we divide it by 2. So after getting the average total assets, we now get the total assets turnover ratio by dividing the net sales of each year to the average total assets. So let's say for example the average total assets is based on the year 2017, so we use the net sales of the year 2017, and so on and so forth. So the higher the assets turnover ratio, the better the company is performing, since higher ratios imply that the company is generating more revenue from the firm from assets. Since the total asset turnover ratio is high in 2015, it implies that every peso in the total assets generates 1.70 pesos in JFC sales.
Good day, ma'am. I'm Siti Hananor. I'm going to report receivable turnover. Receivable turnover is a ratio that works hand in hand with an average collection period to give a business owner a complete picture of a state of an account's receivables. It is also an accounting measure used to quantify a company's effectiveness in collecting its receivables and money owned by clients. The ratio shows how well a company uses and manages that credit it extends to the customer and how quickly that short-term debt is collected or it's paid. The formula of this account receivable turnover is net credit sales over or divided by average account receivable. Here's the example to get that. In 2019, the average account receivable is 5,374 plus 5,764 equals to 11,138 divided by 2 equals to 5,569. That is the average account receivable. Then the net credit sales is 166,909. To get the 2, the account receivable turnover ratio is 166,909 divided by 5,569 equals to 29.971. That is the account receivable turnover ratio. For the remaining year, do the same process of computation and you will get the account receivable turnover ratio. For analysis or conclusion is a high accounts receivable turnover ratio like the one in 2016 is considered favorable since it shows that Jollibee Food Corporation has strong credit policies regarding to their collection efforts.
Hello ma'am, I am Sharmil Pepito, and my topic, together with Miss Amante, is the average collection period. The average collection period, or also called days sales outstanding or days sales receivables, measures the number of days it takes a company to collect its credit accounts from its consumers or customers. It represents the average number of days between the date a credit sale is made and the date the buyer pays for that specific sale. Businesses must manage their average collection period so that they may be able to ensure that they operate smoothly. Companies must calculate the average collection period to make sure that they have enough cash on hand to meet their financial obligations. It is calculated by dividing 365 by the receivable turnover. So, for the year 2015, account receivable turnover ratio is 15.072. 365 over 15.072 is 24.217 or 24 days. For the year 2016, account receivable turnover ratio is 29.653. 365 over 29.653 is 12.309 or 12 days. For the year 2017, account receivable turnover ratio is 35.1197 and 365 over 35.1197 is 10.393 or 10 days.
Hello Ma'am Kagape, I am Maria Eliza Amante and I will be presenting the continuation of average collection period from year 2018 to 2019 of the JFC Corporation. So for the 2018, we have the receivable turnover of 36.306, then 365 over 36.306 is equal to 9.971 or 10 days. As for the 2019 average collection period, we have 30.869 as our receivable turnover. Thus, 365 over 30.869 is 11.824 or 12 days. So overall, these are the average collection period for the last 5 years of JFC. So we have 25 days for 2015, 13 days for 2016, 11 days for 2017, 10 days for 2018, and 12 days for 2019. So the range of the average collection period for the last 5 years is only 10 days to 25 days. So if JFC has a credit term of 30 days, thus the average collection period of the last 5 years, especially in 2018, is favorable since it does not exceed the 30-day credit term. So that's all for the average collection period of the JFC Corporation.
Net working capital turnover. Working capital, also known as net working capital or NWC, is the difference between a company's current assets such as cash, accounts receivable or customers' unpaid bills, and inventories of raw materials and finished goods, and its current liabilities such as accounts payable. Net working capital represents the cash and other current assets after covering liabilities that a company has to invest in operating and growing its business. In other words, it represents that funds an entity has to cover short-term obligations such as payroll, rent, and utility bills. The formula in getting the net working capital is total current asset minus the total current liabilities. In 2015, the total current asset is 27.17 billion minus the total current liability is 21.7 billion is equal to 6.1 billion. In 2016, the total current asset is 30.37 billion minus 23.83 billion is equal to 6.54. In 2017, the current asset is 37.33 billion minus 26.95 billion is equal to 10.38 billion. In 2018, 42.74 billion minus 34.18 billion is equal to 8.56 billion. In 2019, 45.628 minus 62.30 billion is equal to negative 16.402. Based on the computation, the company was more liquid in 2017 comparing to the other previous year. Thus, in 2017, they were more capable to pay their short-term obligations. However, in 2019, the company had a negative net working capital. That is because their current liabilities are more than their current assets.
So for the overall analysis of the asset management of the JFC Corporation, we are going to answer 4 questions regarding to it. Is the company liquid? Do they manage their assets well? Are they risky? And would you invest in the company? For the first question, is the company liquid? Based on the analysis in the net working capital of the company, JFC was liquid for the past 5 years, except in 2019. It was illiquid last 2019 since they had more debts than their assets. To further support this conclusion, the company's current ratio was also solved. It also showed that the company was liquid from the years 2015 to 2018, especially in the year 2017. For the second question, do they manage their assets well? The computations from the total asset turnover ratio up to days sales inventory shows that the company manages their assets well. The 1.58 industry average of the company shows the total assets computation for 2015 to 2017 was increasing. However, it became equal to it in 2018 ratio, then decreased in 2019. The fixed asset ratios also show a declining trend, meaning that the company is investing more in long-term investments. Their strict credit policies were shown through the amounts in receivable turnover and the average collection period. Since the inventory turnover results are high, then it means a high demand for the company's products. Third question, are they risky? GFC's financial statement shows positive outcome for the company and for its investors. We know that GFC is still vulnerable to risk. Investors should alleviate the risk of their investment to reduce the probability of loss in the future. The analysis of the JFC's financial statement gives potential investors future in investing. Therefore, the Jollibee Foods Corporation is not risky but is still vulnerable to risk. For the fourth question, would you invest in the company? Yes. Aside from its known reputation in the food industry, the computations and analysis from the company's financial statements showed that it is worth it to invest in the Jollibee Foods Corporation. So that's it for the asset management ratio of the Jollibee Foods Corporation. Thank you.